Gold and silver both have qualities that they have never been able to duplicate with any other materials. Gold is recoverable. Silver gets used up in manufacturing, but gold does not. So you can recycle it.
Diversification is one of the most important things to do when managing a portfolio. When done correctly, diversification can increase the rate of return you can expect for a given amount of total risk or decrease the risk required to achieve a given rate of return. When the price of some assets rises, others tend to fall, creating opportunities for contrarian investors to invest capital in these undervalued assets. Having a small allocation to precious metals like gold and silver is a useful part of diversification, as they are partially uncorrelated to stocks and bonds and present different and unique risks and opportunities. There may be times when a larger allocation is useful from a tactical standpoint as well. In today's video, we'll tell you why Lynette Zang says this is the best time to own gold and silver. But before we get into the video, make sure you subscribe to our channel and press that bell icon to never miss an update.
We can account for roughly 98% of all of the gold that has ever been mined. And it can be melted down and reused in completely different ways.
Governments and central banks want to manage your mindset because if they can manage your mindset, then you're moving forward. You're moving voluntarily in the direction that's called nudging. You move in the direction they want you to go to. A trillion times zero is still zero, and people don't realize they're trying to beat inflation, and under normal circumstances, they can with many fiat money products. But we're at the end of this life cycle. There's hardly any purchasing power left in any of the currencies, and the only reason they're viable is because we believe they have value. Therefore, we're willing to work for them. We're ready to save them. We are ready to use them as a bartering tool. But the rapid inflation that the world is experiencing right now really shows everyone the truth, because all of that inflation that has been going on in the stock market, the bond market, the real estate market is now coming back into the economy. Zimbabwe has raised rates by 14,000 basis points since the beginning of the year, and they're close to the official inflation of 200%. So what's happening right now is we're going back to a system again. It's the debt-based system. So what you have to understand about money is that when we had gold, if you didn't like what the government was doing, you just took it out of the system that created restrictions around the government, but it was private. It's decentralized. You own it. And you run no counterparty risk. Then we went to the next system, where you could have a dollar for a period of time. You can convert dollars to gold and gold to dollars quite easily. You went to the banks. Yes, but once they took that privilege, we were in a federal note, a Federal Reserve note system. Well, if you keep the money in your pocket, it's still private, but you can't escape inflation that way because that's how the system was designed for the next system. Well, there is nowhere to run because if everything is digital, all your income will come in. Every penny you spend will come out. And what governments are talking about with the new system is that they will have the ability to pay taxes for life. If you own mutual funds, you pay taxes annually. But with the new system, you can determine how it will be, and they can change the laws and the central banks, which is even worse. You will lose all control with the central banks. What they're saying is that then there will be no limit to how deep you can go. While inflation has robbed you of your purchasing power over time, there's practically no more purchasing power. When we're fully digital, they can tell if they're getting those results in real time. So, for example, as a consumer-driven economy, if you're trying to save money, but they want you to spend it, they just lower those rates so you can see your principal evaporate. And you didn't even spend that money on anything. When entering a crisis, you don't want to hold an asset that only has one and is only used in one location. So you want to keep an asset where everyone uses it. Maybe it goes higher, maybe they use more, maybe they use less. So it's a true supply and demand economy, but it never drops to zero because of its usage and functionality. When you run into a crisis, you want as many buyers of your assets as possible, and you will keep it to a minimum in the best way. Both gold and silver have qualities that they've never been able to replicate with other materials. And so, for example, you can draw gold super fine and conductivity is superior to any other alternative that they can possibly use. Also, gold is recoverable. Silver is used in manufacturing, but not gold, so you can recycle it. And we can represent about 98% of all the gold that has never ever been mined. And it can be melted down and reused in completely different ways. Although the widely held popular belief is that there is a strong negative correlation between interest rates and the price of gold, a long-term examination of the respective paths and trends of interest rates and gold prices reveals that there's no such relationship. The correlation between interest rates and the price of gold over the past half century since 1970 has only been around 28%, and not considered significant. Commodities, including precious metals, don't produce cash flow like a profitable business or even an interest-paying bond does. Instead, they just sit there because you expect their price to go up. Gold and silver are good at maintaining their long-term value against inflation. We've all seen areas affected by devastation, be it economic or weather-related, where it's nice to have durable assets on hand. Banks or electronic payment networks cannot always be relied upon to provide the necessary funds in times of crisis. During the gold bull market of the 2000s, interest rates globally fell significantly as gold prices rose. However, there's still little evidence of a direct and sustained correlation between rising rates and falling gold prices, or falling rates and rising gold prices, as gold prices hit their peak long before the most severe drop in interest rates. Like any other investment, the price of gold fluctuates. Investors may have to wait a long time for profits, and research shows that most investors enter when gold is near a peak, which means the upside is limited and the downside is more likely. Meanwhile, slow but steady treasuries offer less excitement but reliable income. Historically, hyperinflation became possible when fiat currencies replaced precious metals as money. Since fiat currency is not convertible at a fixed parity into gold or silver, governments or central banks can print it in virtually unlimited amounts. Although gold is not always the perfect hedge against low and stable inflation, it almost always protects against high and accelerating inflation. Indeed, hyperinflation destroys confidence in the national currency, leading to a flight to safety. At times like these, people are looking for real assets, hard money, or safe havens like gold. That's why hyperinflation in a key world economy, especially the United States, would drive up the price of gold. Today, most of us save the extra money we have in our bank accounts to earn decent interest over time. But when hyperinflation occurs, your savings disappear as they lose value and thus become worthless. But gold behaves differently. It beats the rate of inflation to save your investment. Your purchasing power can even increase if you have gold in such conditions. So between currency and gold, you should choose gold as your investment. This is the reason why many countries like to invest in gold for a longer time. If you have extra money and are looking to invest it somewhere, look into gold investments. Finally, everyone likes to be ready for a rainy day. Gold is beneficial for both short-term and long-term investments, and it protects against hyperinflation.
So what you need to understand about money is that when we had gold, this was, if you didn't like what the government was doing, you simply pulled it out of the system. That created restrictions around the government, but it was private. It's decentralized. You hold it, you own it, and it runs no counterparty risk.
That's all for today. Let us know your views in the comment section below. And don't forget to like this video before leaving. Thanks for watching.